The interest rates, the risk-free rate in the US, the lower bound has been zero for 95 out of the last 155 months since 2010. The world has changed completely, and as a result, almost every single investment strategy that worked in the last 10 years is almost certainly not going to work in the next. And that's how profound it is. And I still don't think the market has fully appreciated this.
Well, the market's made lots of assumptions, hasn't it? And some of them that you challenge. You call it the flawed Fed pivot narrative. Why is it flawed?
Because two principal reasons it's flawed. And let's just be clear what that pivot narrative is. Essentially, the pivot narrative is a narrative where the Fed will cut rates at some point in the relatively near term, some point during 2023. Now, this has changed over the summer. In the summer, it was spring they were going to cut rates. Now it's the second half of 2023. And it's the only narrative that gets that risk-free rate down. It's the only narrative that supports the investment strategies that have worked, particularly growth investments and all the range of others that have worked in the last 10 years. Now, why it's flawed? Well, two reasons. One, because the Fed governors keep telling us it's flawed. Yeah. They keep repeatedly saying that rates are going to be held for longer and well into 2024. The second reason is history. And everyone's ignoring the history. In the 1970s, and Powell repeatedly refers to the mistakes the Fed made in the 1970s, but no one's listening. The mistakes of the 1970s were twofold. One, they didn't appreciate the threat of inflation in the early 1970s, and secondly, they cut rates too quickly and too far in 1974. Now, the Fed have made the first mistake. They're definitely not going to make the second.
Well, I mean, you can give the Fed a certain amount of breathing room here, can't you? Because, I mean, governments at the time were spending aggressively through the 70s in the United States on foreign policy and domestic policy. So, I mean, where Steve came in was the issue of governments being a little careless with the taxpayers' money. We've kind of had one of those periods again here, haven't we? We've got a government that seems to think that you can conjure up $1 billion from the debt market just like that and go out and spend it. But we're getting away from, I think, what our audience would love to hear, and that's what they should be buying and investing in at the moment, given that they now have to think about that 4% rate.
Well, I mean, that is absolutely key to this. I mean, for the first time in 10 years, there's this expression, there is an alternative, which is cash, treasury bills, 2-year bills. And that changes the investment horizon completely, because all of a sudden, the growth investing that we saw over the last decade, buying a company on 25, 30 times, which has 7% growth, which is a typical UK quality growth stock, has 7% annual growth, predictable, I accept. When you could earn 4% over the night, that just doesn't work. So growth investing does not work in this new environment. High multiple, high PE stocks do not work. What one needs to be looking at, we think, is very much more what has underperformed over the last 10 years, and that is essentially value, though I struggle with value per se, but certainly low multiple stocks is where people should be looking going forward. And there's another really historical point here, historical precedence, is that, again, looking back over cycles, it's very, very rare, if not never, that the sectors that led into a bear market, led into a recession, lead out. And so on that basis, value has been out of favour for the last 10 years. I suspect value is going to be very much in favour over the next few years.
How do we treat income at the moment, Roger? Because for the same reason that those growth stocks don't look attractive, i.e. there is a risk-free rate out there at 4%, which just happens to be the long-term average of the FTSE 100 yield as well. High income doesn't look quite so high income anymore, but they tend to be gravitated on some of those more value stocks arena, or stocks that have been beaten down with lower PEs as well. How do we treat some of those stocks now, given the fact that 6% is not quite as attractive as it was when gilts were trading at 1%?
That's one of the great paradoxes in the equity market. Why does no one want 5% plus yielders when gilts are 1%? Why is that? Well, of course, because the market is assuming if gilts are yielding 1% or 50 basis points that there is no growth. So the market, in making that assumption, is assuming that there is no growth, therefore these stocks on 6-7% yielders aren't going to grow, and in fact the likelihood is their dividends are going to be cut.
Yeah.
Now, of course, when the risk-free rate goes up to circa 4%, that is implying some underlying growth. Now, whether that's nominal, which I think is probably what this mostly will be, rather than real growth, it is implying a nominal growth environment of 4%. So as we just discussed, growth becomes very unattractive. But in a nominal growth environment of 4%, most companies, you know, these GDP type plus companies that we used to talk about, they can grow. Therefore, that dividend is secure. Therefore, that dividend can grow. And that's the key. But yes, it's an equity paradox. You know, why does the market have no interest in these stocks at 1% and yet they think they're great at 4%? But that is why.